Hi everyone, Jordan here from ASM-Trading, and welcome back to the second video, part 2 of Forex for Beginners. If you're yet to watch part 1, I'd recommend maybe going back over the first video, just so if you are just starting out, this video does make total sense, because we'll be talking about a couple of things that was mentioned in the previous video. But without further ado, let's just get right into it. So today's agenda then, and what we're going to be covering off for you today. First of all, we're going to be talking about candlesticks, explaining what they are and how you read them, as most traders do tend to use candlestick charts more than most. We're going to be looking at market structure, the different price movements, the names of them, and how you identify them. We're going to be looking at support and resistance zones. One of the key areas this is for retail trading, and will be vital to a lot of the strategies you may learn as you go along. After the support and resistance, we're going to be talking about areas of value or points of interest. So these are just areas on a chart that traders use to place their trades to get their best results. Then once we know where we to place a trade, we're going to be looking at using risk size calculators. This is so you can efficiently calculate the risk you want to use on every trade. Because we're going to be using leveraged accounts, this is just to make sure you never lose more than you intend to on each trade. And then lastly, once we've used the risk size calculators, we'll just give a quick example of how you can then place them trades with your broker. So by the end of today's video, we should have a good understanding of very basic chart and technical analysis. You should be able to know how to manage the risk when you're placing trades, and being able to place a trade with your broker, so we can go away and start practicing these on your demo account, start looking at some charts, just get used to place some trades. It will be vital before going on any live account. So let's get into it then with candlesticks. So what is a candlestick? A candlestick in a chart shows the price movement over a set of time. The time can vary depending on the user's choice. Now, when you're looking at a chart, you will have an option to look at the 1 hour chart, where each candle represents a 1 hour time frame. You could look at the daily chart, where each candle represents the daily time frame, or you can go all the way into the 5 minute, 1 minute chart, where each candlestick will represent, possibly 1 minute, 5 minute, depending on what you're looking at. You can read a candlestick by looking at its color, body, and wicks. And knowing how to read candlesticks can help you predict what price does next. Candlesticks themselves can form patterns to suggest the next movement, which I'm not going to go into so much today, but I will be covering off in later videos. We'll be looking at different candlestick patterns, things to look out for in the charts. But today I just want you to understand the one candle itself and what it represents. So the body of a candle represents the opening and close time of a price during that period. And then the wick represents how far price moved during that period. And then thirdly, the color represents if the candle was bullish or bearish. Remember, bullish means price going up and bearish means price going down. So it's easy saying that, but let's actually see an example of a candlestick. So here we have two candlesticks. The first candlestick we got on the left is a bullish candlestick. How do you know it's bullish? Well, it's green, and usually in trading, green means bullish. And on the right, we have a bearish candlestick, where we know that because it's red, or I think it's a bit pink in this one, and red usually means bearish. Now, when you're looking at charts yourselves, you can customize the colors to suit yourself, but generally, green is bull, red is bear. So when we look at this candlestick then, we know that the candlestick, being green is bullish, has moved in an upwards momentum. Now the bodies, as we can see here, represents where the price opened. So at this moment in time, this is where the candle first formed. So let's say this is a 1 hour candle. On the new hour, the candlestick opened here and closed here. So we know during this hour, this is how far prices move. Now, the wicks then are representing the overall movement of that time period. So for example, it could open here, it could drop down here, can move all the way up here and then close here, and that's how that wick was formed. Now, it doesn't necessarily mean to be in that order. You know, we could have opened here, could have gone all the way up here, all the way down here, then closed here. You know that by looking at the smaller time frames. So if you wanted to know what happened during this 1 hour candle, you could maybe go down to the 30-minute candle or the 10-minute candle, which will split this 1 hour candle into smaller candles for you to look at. Same with the bearish. Now, we know that with the bearish candle, it opened here because it's red and price had to move downwards. The price closed at the bottom of the body of the candle here. And we know during this period of time, the price had moved as far as high and low as these wicks went. So again, it could have opened here. Price could have moved up, then sellers kicked in, push it all the way down to this low, and then the buyers kicked in enough to close the candle here. Now, this is a very generic looking candle. When you're looking at a chart, these candles are going to be all different shapes and sizes. You're going to have some where the body's up here. There's going to be a long wick down here. You're going to have some bigger than others, some bigger bodies, some bigger wicks. And when we go on to a future video, I'll go and explain a bit more about what these different types of candles can actually mean to the price. But for now, I just want you to understand what these candles mean when you start looking at the charts. So hopefully that makes sense. And let's move on then. So the next thing then we need to talk about is market structure. So you are going to need to understand market structure if you want to be a successful trader. Now, market can move in many different variations and forms, but I just really want to try and keep it simple in this video. So let's just break it down. Primarily, market structure can be categorized into 3. So first of all, we have what we call a bull market. You've heard me say a couple of times, bull means up. So this means the price is on an upwards trend. And here's an example here. So you can see this is a candlestick chart. And you can see the red's bearish candle, green's a bullish candle. And you can already see how many different shapes and sizes they make. But generally, you can see that these candles are on an upwards trend. Why do we know that? Because we're making higher highs, a higher low, higher highs, higher low, higher highs, higher low, and it's generally in an upwards trend. So really easy to establish. The next market you could be experiencing is a bear market, and I said this a couple of times already, and this basically means that price is on a downwards trend. And how do we know it's downwards? Because we're creating lower lows and lower highs. So we've got a high here, then we got a low, then we got a lower high, lower low, lower highs, lower low, lower highs, lower low. And that's generally how we understand what a bear market is. Then we do have this certain price movement in the markets where it's kind of price doesn't really know what it's doing, whether it wants to go upwards or downwards. And we usually call this a ranging market or consolidation. Now, this just means the price is moving sideways. And how do we know this is consolidating or ranging? It's because it's not creating high highs, higher lows. It's reaching the same lows and the same highs before continuing on a sideways market. Now, all 3 of these markets you can trade in to make money, which we'll talk about in a moment. And you may be thinking, how can I make money with the prices going sideways? Or how it's going up or how it's going down? And the real reason you need to understand how that works first is by understanding support and resistance. I guarantee you, if you haven't already heard about support and resistance, you're going to hear the term come up a hell of a lot, especially with certain retail trading strategies. Or if you're a swing trader like me, support and resistance is sometimes your best friend when it comes to trading. So what is support and resistance? So support and resistance are an area on the chart from which price rejects. So support is when the price comes down and then rejects back upwards. So for an example here, price has come down, it's found support. How do we know it's found support? Because the price is rejected back upwards. And again, it's rejected back upwards, and again, it's rejected back upwards. So we know this area is an area of support for that price. So whenever this price seems to come to this area, it seems to find support and then move upwards. Resistance is basically when the price moves up and rejects downwards. So it's the complete opposite to what support is. So you can see it's just like flipping it on its head. and you can see the price move upwards. It rejects at this point, so we know this is an area resistance. So it's likely when it comes back to this point again, it could find resistance again. And in this example, you can see that the price is rejected from that resistance point 3 times. Generally, that's what support and resistance is. Now, with, you may be thinking, how do you figure out support or resistance in a market where it's constantly moving upwards or downwards, like a bull or a bear market? Because it's not going to always reject from the same point. These are more something you can look at in a ranging or consolidating market. So it's important to know then resistance can become new support level and vice versa. So look on this example I've given here. Let's pretend this arrow is the price movement, and we're in a bull market because we've got higher highs, higher low. And you will see this in most markets, and you'll see it everywhere when you're looking at charts, whether you're looking at Forex, whether you're looking at stocks, even Bitcoin or other cryptocurrencies, that the price has moved up and it's rejected back down. So we know this is resistance. Then the price decides to move back up, but it's broken this resistance. We've had a breakout, confirming the bullish trend. When the price moves back down and it comes to this area where the resistance was last seen, it finds support and moves on upwards. So support can become resistance. Now, let's just see how we work this out with real market examples, covering the 3 market structures from earlier, because these are going to be the 3 main market structures you're going to be analysing in your charts. It's easy to look at, drawing a couple of lines, but I've taken some examples from an actual chart and we can work from them together. So from what we learned earlier, I want you to have a think about what market structure is this. And you probably already got it. I'd be surprised if you didn't. It's a bull market. And we know it's a bull market because it's creating higher highs, higher lows. So where on this chart then are we going to find support and resistance? So we know prices come down, it's moved back up. So this area naturally is going to be our support area. We know that because prices come down, it's rejected back up. Now, when the price has gone up and it's rejected back down, we know then this area is going to be our resistance. Now, from our example earlier, we're talking about a bull market. The price has then risen back up, broken the resistance before coming back down. And if you notice, when it's come back down, I've highlighted here, the resistance now becomes the support. Because we've broken through the resistance, now that actually becomes support. And you can see how that works. And this is a real life example. I've just taken a screenshot from a random chart of a bull market. And you can already see how knowing this can benefit you when you're trading the markets. Now imagine we didn't have the rest of this and we've seen it gathering some support at this last resistance. You could easily think about how we place some buys, which I'll show you in a bit later on. And as price continue upwards, we see it time and time again. So we've got this area here where we've had resistance, then becomes support, and then this area here where this resistance now becomes support. Now let's see another example, and again from what we learned earlier, our market structure is this then. Of course it's a bull market, and we know that. You can obviously see the price is trending downwards, lower lows, lower highs, and we know it's going to do the opposite to a bull market. Now, where's our first resistance? So the price has gone up. And first of all, we've got support in this area. And we know we've got support because the price is rejected and gone upwards. Then the price has come back down. So we know this is our resistance. Once it's come back down, the price travels back up. And little behold, we have resistance in this area, just where the support is. So on this case then, this bull, in this bear market, previous support now becomes resistance. It's just like clockwork. You can see it's broken down and it's coming back up, but as soon as it gets to this old support, it now forms a new resistance and price moves downwards. Again, you can see how easy just knowing this could be to enter trades in the market. So you're going to be looking for sells. Again, as we move down the market, this old support, as it makes its way through, now becomes new resistance. And again, this support here we have a bit of sideways movement here. It's not sure what to do. Looks like it's going to break upwards and then straight at that old support now becomes resistance. And it's as simply as easy at that. And then lastly, what market structure is this on this last example? Yep, so it's a ranging market or consolidation, whichever one you want to call it. And we know this is ranging or consolidated because the price moved upwards before moving back down, before moving upwards and moving back down. So we're having our support areas around here and our resistance up here. So if we just mark that out, we've got our resistance. It's not breaking above this general area. You can see a couple of wicks have gone maybe a little bit above, but generally the bodies of the candles are not finishing above this area. As soon as price wants to try and break above, the sellers kick in, pushing the price back down. And then again, this support area, you've got 1, 2, 3, 4, 5, potentially 6 points where the price has come down and has found support from this area. So we got clear understanding of what support and resistance is in a consolidated market. And you can see once this price is ranging in this area, how easy it could be to capitalize on making buys and sells in a ranging market. So now we know what support and resistance are. We need to figure out and understand where our areas of value are on our charts. And an area of value, or I like to call them a point of interest sometimes, is an area of a chart that traders will wait before placing a trade. Because basically, when you think about it, if a price is moving upwards, you may think, oh, let's just buy. Well, you don't just want to buy straight away because that price may retract, and if it does retract, it may keep going down, so it may mean you lose more money. It may also mean you're not going to make as many profits. If a price is broken out, you're never going to want to buy straight away. You're going to want to wait for an area of value to get the most out of your trade. So, like I said, just because price moves one direction doesn't mean we should immediately place a trade. And I think the best thing to do is, let's see some examples of using an area of value to actually make a trade then, okay? So here we got, again, a bull market. We know it's a bull market because it's creating higher highs, higher lows. And because it's a bull market, it's moving upwards, and we're going to be looking for buyers because we're going to want to buy in with the trend here because it's trending upwards. And so you're going to place buyers because you're not going to want to make sells in these types of markets because you're not going to make much money. It's going to be much harder to try and get in on that trade. So thinking back about where our support and resistance areas were and how on this example, resistance now becomes support. We're going to mark up our areas of value. So we've got one round here because all resistance becomes support. All resistance becomes support. All resistance becomes support, and again, all resistance becomes support. So these are going to be our areas of value. So you might think, how am I going to, make a trade knowing this information then? So let's say, for instance, we know this is resistance. The price has moved upwards. It comes back down to a resistance level. We now know we're an area of value, so we're going to want to place a buy around about here. As soon as the price gets to this area, you're going to want to buy. Now, when you're placing trades in Forex, you're always going to want, when you place a trade, whether it's a buy or a sell, you're always going to want to place a stop loss. Now, a stop loss means if the price moves against you, so if we want to buy here and the price decides to move downwards and it changes direction of the trend, then your stop loss is going to cut the trade short, so you're not going to lose too much money, or you're going to only lose what you intended to if the trade went wrong. And you're also going to want to place what we call a take profit. Now, a take profit means if the price moves upwards and it hits your target level, it will close the trade out in profit to make you money. So you don't have to watch all the time to close a trade. As soon as you just take profit, the broker will automatically close that for you. So in this case then, we're going to want to place our stop loss just below this area of value. And why here? Because if it breaks past this support area, then it's a good chance it's going to start trending downwards because it's broken this support area, and it could start trending down. So we'll cut the trade out here. Then we're going to place our take profit of right about here in the market. And why here? And the reason being is last time the price peaked about this point, and we know this could be another area of resistance again. So it's a really good target to aim for. And we know that the price has got a really good chance at getting here. Now, there are, other methods you can use to trail your stop loss and, maximize profits. But we'll look at that in later dates. This is just a really simple trade. And you can see here, if you're risking about 1%, you're going to be making about 2%. So if you're risking £10 on a trade, if it goes right, you're going to be making about 20, which is really good. Now, let's see a different example then. So that was a buy. Again, we know this now is a bear market, and we know it's a bear market because it's going downwards. So we're going to be looking for sells. And as I mentioned in part 1, with trade and Forex, you don't just make money when the price is going up. You can make money when the price is going down, because you've got the option to buy or sell any Forex pair and make money regardless of the direction it's moving. As long as you know which direction it's moving, you're going to be profitable. So again, we know this support area becomes resistance. So there's our first area of value here. Again, this support becomes resistance, area of value. And again, this support becomes resistance, area of value. So we know these are all of our area of value. So if we're going to be placing a trade in this market, you are going to want to do it in one of these areas. Now, we've got the ability to see what actually happens with this price. It's a bit different when you're looking at the live market and it comes down. But when you're looking at these pairs, you're going to see these patterns form really frequently. Now, how are we going to place a trade in this bear market? So once the prices come down, it's moved back up, and we know it's hitting our support area, so it's likely to become resistance. And we know that because we're in a bear market. You're going to want to place a sell round about here. And then your stop loss is going to want to go just above. And why here? Because if the price does break this area, then it's a good chance it could start trending upwards. You may as well cut that trade short. Remember, it's always better to cut your losses short and let your profits run. Now, your take profit then is going to be around about here. And why here? Because we know the price has moved down to this area before, so it's likely going to get it again, at least, if not more. And it's as simple as that. Really, really easy stuff. And lastly then, let's take a look at our consolidated market or ranging market and how we're going to find areas of value to place trades. So with a ranging market, you could be looking for buys or sells. It's not going one way or the other. So you're going to be looking for buys when we're down below, and we're going to be looking for sells when we're up high. So our areas of value then, you can see our support areas. We've got 1, 2, 3, 4, 5, maybe 6 as well, if you want to count that one. And our resistance areas, we can see clearly here and here. I wouldn't quite call this an area of value for me, because it's not quite made the same highs that it has here, but these definitely. So our support areas of value, and then our resistance areas of value. So if you wanted to make a buy in this market, then you're just going to, really easy. We know that price of rejecting at this point. So when we get down here on our third support, or any of the supports you could do this on, you're going to want to buy. Your stop loss again, just like the other trades, just below this area. So if it does move downwards, you're going to stop yourself out, and your take profit is going to be towards the highs of the resistance. So when the price moves up, you're going to make some money. And then exactly the same for the reverse. So because we're in a consolidated market, we can do buys and sells. So if we're looking to sell, you'd want to sell around about here. We know this is going to be a resistance area because we've resisted from this point before. So once it comes here, you're going to place a sell. You're going to place your stop loss just above this area. So we know if it does break above, which may continue to keep going, it's going to cut the trade short. And then you're going to place your take profit at the bottom where we're finding support, because we know it's going to get a likelihood, if it gets here, it's not going to keep going, it's going to bounce back up. So you want to make your money. And you can see these would be two really decent trades. You've got about a 1 to 3, maybe about a 1 to 4 year risk to reward ratio, which is really good when you're entering these trades. So now we have your area of value. So you could potentially go away right now and you could look at the chart and you could mark up some trades. But the next thing I talk about is probably one of the most important things, because it comes under risk management, and that is position size calculators. Now, if you remember back on part 1, Forex for Beginners, We talked about lot sizes, which probably when you were listening to it was awful confusing at first. And at the time I said, don't worry, we're going to talk about position size calculators to make your life easier. So the first time I seen lots, I didn't know what I was doing. I still don't work these up manually myself. I still rely on position size calculators to work out every single trade that I take. So position size calculators are used by traders to work out their lot sizes to be able to manage risk. By using a risk size calculator, you won't lose more than you intended to in nearly all cases. Now, when I say nearly all cases, and the reason I say that is because when you have a stop loss set and you've worked out your risk, if the price moves to that area, it's going to cut you off. You're not going to lose how much money you intended to, or more money than you intended to. The only time that is at risk of this actually failing is if you're trading during a really heavy induced news period where price goes extremely volatile and moves so quickly that sometimes you can get something called slippage. Now, slippage basically means if the price moves so quick past your stop loss that your broker can't close your position in time before it actually going over what you intended to lose. Now, this is very rare, and before you actually go into your live trading, in my future videos, I'm going to be talking about how to read the news and how to avoid these cases at all costs. So you're never going to experience these as long as you follow my instructions. But that is rare. Even if you didn't pay attention to the news, that's rare that that's even going to happen to you. And even if it does, it's not going to be too dramatic anyway. But I just wanted to make you aware. So let's have an example then of when we may use a position size calculator. So if you had, let's say you had £1,000 in your account, and you wanted to risk 1% per trade. So every trade you're taking, you didn't want to risk 1%. And in this case, 1% of £1,000 is going to be £10. So once you know where your stop loss is then, you then need to work out how many lots you're going to need. So when we talked about in the examples, you know you're placing your stop loss just above or below those support areas or the resistance areas. Once you know where that is, you need to work out if it does move up against you or down against you, and it hits your stop loss, that it's not going to actually make you lose more than £10 in your trade. So like I said, if you do it stop loss, your account will only suffer a £10 loss. And therefore demonstrating proper risk management, which is going to be the most key thing you take away from this video today. Now, it's easier if we have a real life example. So I'm actually going to get a real life example up now, and then we're going to work it out together ourselves on an actual risk calculator that I use personally. So below is a typical example of a buy setup on the Great British Pound versus the US dollar. And we know it's a buy because this is this is a bull market creating higher highs, and we've got this resistance here, and it comes back down, finds a support area, so we're going to want to place a buy. But this time, let's add some actual numbers to it. So we buy Great British Pound versus the US dollar at a price of 1.19997. Now we're going to place our stop loss just below this area, and the price of the stop loss is 1.19768. So, and you're going to know these prices because when you're looking at the charts yourselves, you're going to use the tools in there to place your buy and your stop loss so you know what these prices are going to be. And then we're going to probably take profit at this sort of next resistance area and take profit. The price of that is going to be 1.20542. For the sake of the position size calculator, we don't really need to know the take profit. We just need to know what our stop loss is. But I put the take profit in it just so we can see it as a whole example anyway. So first of all, before we go on to a risk size calculator, we need to work out how many pips away your stop loss is from entry. So that's a difference in pips between the buy and the sell. Now, if you remember going back to Forex Part 1, we went through how to work out the difference of pips and different prices, but we'll go through it quickly together now. So we're just taking the buy amount, which is the larger value of 1.19997 minus the stop loss amount of 1.19768. That equals 0.00229. So at face value is 22 pips, but you know, my OCD means we've got to definitely round this up. So it's 22 pips, but really it's 23 pips rounded up. So now we have all the information we need. We have a £1,000 account, we're risking 1%, and we have a 23 pip stop loss. Now it's time to use the calculator. Now the calculator I use is on MyFXBook. Now you might have heard me mention MyFXBook a couple of times in my last video, and nope, they don't sponsor me, or I've got no affiliation with them. I just think they're a really good website for multiple reasons, also including position size calculators. So it's really simple and straightforward then. So the currency pair we're going to be trading with is the Great British Pound versus the US dollar. So we just got to find that. The account currency is Great British Pound because I'm trading in sterling. Our account size is £1,000. We're risking 1%. Now you can change this little button. You can say I'm risking £10 if you want to work out how much money you want to risk, but I work in percentages, so we'll just stick to the percentage. So we're risking 1%. Our stop loss in pips is 23, we worked out, remember? And this last bit down here does confuse people sometimes. It's your trade size lot. Now, every single broker I've worked with, I've just left this at 1. So you're going to leave this at 1, you don't have to change that. But if you really want to work it out, if you want to know, well, how many units you're trading per lot, then if you go into your MetaTrader and click on symbol properties, it will tell you there, and usually it's 100,000 units. But in this case, it's 1. Now, all you got to do then is click calculate. And you can see down here, it works out. Money risked in pounds is 10, and the sizing is 0.05 lots. So it's as easy then as going into your MetaTrader or whichever broker you're using, if you're using your broker's app, and placing the trade with the 0.05 lots, making sure your stop loss is at the price that you've worked out. And as simple as that. If the stop loss gets hit, you're not going to lose more than £10. Really, really easy. So now that you know how to work out your stop loss using the risk size calculator, which is really easy, the next thing you're going to learn to do is actually placing a trade with your broker. So the best way to show you is actually just doing a live example. I'm going to bring up MetaTrader 4, which is one of the main platforms everybody uses for trading. I suspect you'll be probably using it yourself, unless you have an iPhone, in which case it might be a little bit more difficult because I believe the Apple Store have actually blocked MetaTrader due to it being a Russian company and there being sanctions. But if you're on Android, that's fine, but you can also get MetaTrader for your Apple Mac or your PC. Now, although I'm bringing up an example on the screen, which is the the PC-based platform for MetaTrader, I don't really use this hardly at all. Not for just placing manual trades. I much prefer placing trades on my phone. The user interface is a lot more friendly. So that's what I kind of default to, but just for the sake of this example, because it's going to be a bit awkward if I show you off my phone, I'll show you how it's done. It's the same thing in principle anyway. So using the example we had then, we want to place a trade on Great British Pound versus US dollars. You can see this is the market watch. This is where all our symbols are. And we've got Great British Pound versus US dollar. And you can see we've got a bid price and an ask price. So this is the difference between the buy and the sell. So if you were to buy and sell or buy and close something simultaneously, the difference in pips from these two prices is what you're going to lose in that moment. If you remember, we go back to Forex Beginners Part 1, we talk about the spreads and the pips. So once you know where you want to trade, which is Great British Pound versus the US dollar, you on your phone, you just click onto it, but if you're on the PC or Mac, you want to right click new order. And the next are just going to be simple. So we're going to want to get in the trade now, so it's the market execution. There is options for pending orders. You remember we talked about buy limits, buy stops, sell limits, sell stops. But just for this, to keep it simple, we're going to do a market execution. Now, we worked out for 23 pips to lose £10, we need to trade a volume of 0.05. So this is 0.05 lots we're going to be using. Then we're going to place a stop loss in. Now, I can't do the exact stop loss that was given in the example because price has changed since I've created the spreadsheet and it probably won't register. But just for the sake of putting something in, I'm going to put something in below the current price. So 22565. and then you put your take profit in, which would be accurate, but I'm just going to put another random number. It is 1.24664 or 65645. And then, so you got your stop loss, you got your take profit. We know the value is correct for the volumes. You click buy, and you can see it's done. Now on this chart, you can see it's put the stop. You can see where the stop loss is, and you can see where the take profit is. So if the price here was to move down and hit the stop loss, it'll stop us out the trade. But if it moves up, it's going to take the profit and it's going to get that capture that profit for us. If you're on your phone and you've set the trade, you can open up the chart and just make sure that the stop loss and the take profit looks right compared to wherever you've used. So once you've done that, all you've got to do then is sit back and just see how it plays out. Make sure you do practice this using a demo account before going live. And as always, the number one rule is to always demonstrate proper risk management. So before we just conclude the video then, let's have a recap of everything we've gone over. So we've done candlesticks. We talked about how we read what a candlestick is. We'll talk about the market structure, support and resistance. We've talked about the different areas of value and points of interest and using these areas to place a trade, using risk size calculators, and placing a trade with your broker. I just want to thank you very much for staying tuned for this video. I hope it's benefited you. I'll pop down below the link for my FX book and the risk size calculator. I will also put down below maybe some links for some brokers and also a link for my Discord should you want to pop in, where I'm building a community of like-minded traders to become profitable in the markets. Now go away, practice what you've learned today on a demo account. My next couple of videos are going to be actual looking at different trading strategies, but before we do that, you're going to want to know, what tools to use and to read the chart. So I'll be doing an overview of the system I use called TradingView, which is what I use to analyze all my charts and set up my trades. So please subscribe if you're watching me from YouTube and stay tuned for future videos. Thank you very much. Bye.